Well, our featured guest, of course, is Lorne Steinberg. He's looking, as always, at opportunities for Canadian investors, and you may see some, Lorne, in the Canadian banks and the Canadian telcos.
Sure. I mean, when you look at the dividend yields of companies like BCE and TELUS, 8.5% and 6.5% respectively, often you see stocks fall like that and you expect the dividend to get cut. But when we look at these companies, it remains such a tightly controlled market. We have growth in Canada. The dividends are sustainable. So if investors get into these stocks at these prices, they don't need very much to happen for the stock prices to end up with a pretty darn good return. Of course, both these companies are dealing with regulatory issues, which has made pricing pressure much more severe. And of course, the transition through technology, streaming and the like. But they're well on the way to figuring out how to deal with both of those issues. And in fact, we think on the regulatory side, they may get a little bit of relief from the worst case scenario that's built in. And as soon as we see a decline in interest rates, which we expect sometime this year, there should be a rush to dividend-paying stocks like this, and investors would be well served to step in.
There has been concern recently about BC in particular about the relatively small size of its most recent dividend increase.
Oh, sure. And listen, more moderate dividend increases are the way things are going to be for the next few years. We're not going to see the big dividend increases. We're seeing BCE wanting to maintain a track record of dividend increases, but a couple of pennies a year might be the expectation through 2025.
And the Canadian banks have underperformed for a long time now, a historically long time. You think that this is not going to continue?
Sure. Canadian banks, first of all, have been the place to be for the last 50 years.
Right.
We hate to be customers. We love being owners. The dividend yield, across the board is roughly 5%. And listen, Canada's a growth country. All the fears of housing crash leading to bad loans from the banks has not come to pass. The banks have been protected from the worst of the mortgage loans because they're, not allowed to lend to those customers. So they're in fantastic shape, pristine balance sheets, great dividend yields. We see, returns of 10% annualized for the next 5 years.
Which of the Canadian banks do you prefer?
So I have to say we own the big five. Scotia has the most upside if they can get their house in order.
Right.
TD has some issues on the U.S. side and the like. Royal probably best positioned. But as a group, we like them and we feel what a great place to be.
And how do declining Bank of Canada interest rates fit into your view?
Declining interest rates in the Bank of Canada was always going to be, of course, on the short end. We don't expect there to be big impact on the long end. Therefore, less of an inverted yield curve would be very, very positive for the Canadian banks and should help them increase their net interest margins.
Some of them, of course, are big players in the United States, TD, Bank of Montreal in particular.
And Royal.
Right.
Listen, the U.S. economy remains in fine shape. Those companies are actually, all three of them, very well positioned. They're not in the problem areas. And the regulators basically stopped TD from making a terrible acquisition of a U.S. regional bank. And I think they'll be very, very cautious about acquisitions going forward.
And we're still waiting for TD to do something with that excess capital, correct?
Sure.
One possibility of which is to find another acquisition.
Sure. And I just don't think they'll be in a hurry. First of all, from a regulatory standpoint, I don't even know if they'll be allowed to do anything. And I really, after everything that's gone on the regional banking side, most recently with New York Community Bank Corp, they're going to be very, very careful.